Hello, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, June 8th, 2022, and I'm pre-recording this Trading Places Live for Thursday, June 9th. Futures currently are down a bit. Of course, we still got a long way to go until Thursday morning. But currently futures on the Dow down 56, S&P 500 futures down 9, NASDAQ futures down 38. So on a relative basis and on a percentage basis, we are seeing a little weakness in the NASDAQ futures. We'll see whether or not that carries over into the morning. We do have initial jobless claims coming out on Thursday. And then, of course, on Friday, we get the big May CPI report. So these next couple of days could be really interesting. The market, after rallying for a couple of weeks, has just been sitting, kind of going sideways. That may change with these economic reports next couple of days. Anyhow, crude oil currently up above $122 a barrel. I'll talk about that in just a few minutes. And the 10-year Treasury yield is up to about 3.06%, up another 3 basis points. So we'll see whether or not we can clear that 3.17 level, the high that we saw not that long ago. 3.25%, by the way, is the highest we've seen on the 10-year Treasury yield since 2011. We're only 20 basis points away at this point. So that is kind of scary too. If you're looking for catalysts that potentially could take U.S. equities lower, I think the combination of higher crude oil prices, higher 10-year Treasury yield, and of course, inflation, all of those things are factors that have taken the market down, really over the last 5 or 6 months, and certainly could add to it. We'll see. Let's go through the agenda for today. Going to start off with the daily market recap, then jump into talking technically, relative strength, take a look at some of those sectors and industry groups. Earnings spotlight, not a whole lot there. Things have slowed down quite a bit now, but we do have a couple of earnings reports I'll go over with you. And then we'll wrap it up with the 3 you must see. Before we get into any of that, though, let me take you over to Earnings Beats, where if you go to earningsbeats.com and scroll down, you will see an area where you can subscribe to our Earnings Beats Digest newsletter. This is a newsletter that I publish 3 times a week, Mondays, Wednesdays, Fridays. It's a very quick read, just a couple of paragraphs and a chart. All you need to do is type in your name, email address, hit that subscribe button. There is no credit card required, and you may unsubscribe at any time. All right, let's go ahead and jump in to the daily market recap. So on Wednesday, we started low. We kind of came back in the morning, tried to turn things around, go positive, and then we saw selling into the close. We finished with the Dow Jones Industrial Average down 269 points, S&P 500 down 45, NASDAQ down 89, mid caps down 47, small caps down 21. On a percentage basis, mid caps and small caps got hit the hardest. They've been leading of late. So it's a little noteworthy to see that we did see some weakness there. All of the major indices did close above their 20-day EMAs, though. So we are still trending above the 20-day, but the 20-day, if you look across all of our major indices, the 20-day, even though it's turned higher, is still below the 50. So you got to worry about going back below the 20 and then that 20 rolling over. That is a bearish configuration when you've got prices below the 20, which is below the 50. And that's not too far away. It wouldn't take much selling to get us there. At the sector level, energy higher, not by much, up about 0.2%. But the XLE now up to 92. So it has continued moving higher after working out that the momentum issues that you can see here with the lower PPO, higher prices, negative divergence. We did go back, reset the PPO at 0, went back, tested that 50-day, and now you can see we have, just resumed that prior uptrend. So I think energy continues to look very solid, and really the only area, in my opinion, that looks really bullish. You can look across these others. These were all groups that did not perform well on Wednesday. Real estate down 2.4%. Materials 2.1%, utilities just a little less than 2%, industrials down 1.8%. We got real estate moving back down below the 20-day. The utility group also dropped slightly below the 20-day, 73.66 versus 73.68. The other two, materials and industrials, even though they were down, they are still above their 20-day moving average, but we're teetering. I don't know, if there's a better word right now. We're sideways consolidating, but really we're just teetering just above some key support levels, key moving averages, a little bit more weakness, and I could see things accelerate to the downside. And again, we do have initial jobless claims and then followed by the May CPI report, which will be out on Friday morning at 8:30 a.m. Eastern. 10-year Treasury yield. There hasn't been much in the way of economic reports this week to date. So the bond market, and there haven't been a whole lot of earnings reports. The bond market really is just trading off technicals. I think with that negative divergence, we went back, we tested the 50, we got that center line test, and now we're moving back up again. And you can see that PPO rising. I think we're going to head back, test this 317 area, the high that we saw back on May the 9th. Does it hold? I don't know. It would seem unlikely that we're not going to at least get up and challenge that 3.25 11-year resistance on the yield. So I would expect we're going to take out that May 9th high, challenge 3.25. And I think if we take out 3.25 to the upside, that could be the catalyst to take us to new lows on the S&P 500. So you're going to want to watch that very closely. And of course, what the Fed has to say, the CPI when it comes out, all of this will give us some clues, and then we'll just have to see how the market reacts to it all. All right. Talking technically, thought maybe we'd start off as we usually do with the S&P 500. When I talk about teetering, this is what I'm talking about. We moved up. Normally in an uptrend, I would say we got a price increase, sideways consolidation, that's a flag. I would be expecting a breakout. However, this is a short-term pattern. Short term gives way to intermediate term. Intermediate term is moving lower. Ultimately, intermediate term will give way to long term. And in my opinion, when you look at the long-term chart, I mean, if we go back and look at 15 years on a monthly chart, I don't think there's any question what the long-term move in the S&P 500 is. It's to the upside. And those who are saying, oh, this is different this time. I heard the same thing 2 years ago with the pandemic. I mean, we went from 3,400 down to 2,191 in a month. That drop was much more severe than the one we've had here that's taken 5 or 6 months. Well, I guess, yeah, 5 months. So we've seen this before. I mean, the market needed a pullback. It needed a correction. It needed a cyclical bear market. And that's what we've gotten. Right now on the monthly chart, all we're back down to is the 20. The 20-month EMA. I mean, when you look back since the big move off of 2009 low, we haven't spent much time below the 20-month EMA. A little bit in 2015, 16. There's your trade war. Here's the pandemic. And I wouldn't be surprised. I mean, I think there's a chance we go to 3,500. That was back in January, that was my worst case. I felt like we were going to go down, probably have a cyclical bear market, but my worst case was 3,500. I still think it's possible. 50-month moving average right now, 3,460 and rising. Now you can see the 50-month moving average. On a closing basis, we have not closed any month since, this would have been what, August, September 2011 was the last time we saw a monthly close below the 50-month moving average. Here, March of 2020 with the pandemic, we were almost right on it. Looks like we closed almost squarely on that 50-month. So if we get back to the 50-month moving average, if you're looking for entry into this market, If you've been looking for the last several years and you didn't want to chase, all I can say is you don't see 50-month moving average tests very often. 3,500 would do it. So keep that in mind. All right, one catalyst that could take us there, no doubt, is crude oil. Crude oil prices, I mean, back in March, we had this huge rise, really beginning of December, $65. We doubled to 130 in the span of 3 months. We went all the way back down to 93 or so, $93 a barrel. And now we're making our way back up. And if you look at the daily closes, intraday, we hit 130, but the highest close was 123 and change on a daily basis. And we closed on Wednesday at 122.11. We're very close to breaking out to a new closing high. So crude oil prices, that's definitely one thing. That's one catalyst that could take us lower. 10-year treasury yield, which I already talked about, you get through 3.25%, no doubt in my mind that could create a lot of panic and selling in the stock market. So those are two things. Of course, the Fed's very hawkish right now. Anytime the Fed's hawkish, we have to be careful. So yeah, I still think there's plenty out there to take us lower. And actually, if we go back and we look at the S&P 500, let me go back here. Down here on the bottom, this was the XLY XLP ratio that I like to follow. This is really an important ratio in my opinion, because it's looking at the consumer stocks, consumer discretionary XLY, consumer staples XLP. When the market's good, when we're anticipating a strong economy, we tend to see this ratio rise. And we saw that all the way until latter part of November of 2021. Once that started rolling over, it was a warning sign. It rolled over before we hit our final top. Now, what I would like to see is, I'd like to see if we do move lower one more time. So let's say we go down one more time and take out this prior low, maybe head toward 3,500. What would be nice is if at the same time we see this ratio maybe do something like this. So while prices move to new lows, it would be nice to see, oops, didn't want to do that. It would be nice to see maybe something like this. So you have new price lows, but have a positive divergence. Kind of like here, we had price highs, we had a negative divergence. That was a warning sign. Money was rotating toward the more defensive staples. Here, if we had something like this, it would start showing us a positive divergence as money rotates more towards consumer discretionary. That would be a really good signal. Unfortunately, every time we set a new low, here's a new closing low, here's a new closing low, here's a new closing low, here's a low, here's a low, here's a low. Then we break down here, and guess what? We break down below that prior low. Every time we've had a new low in the S&P 500, we've also had a new low in this ratio. So I'd like to see the opposite. I don't know, not every bottom forms like this, but this would be a pretty good indication. So this is something I'll be watching for. All right, so that's it for talking technically. Let's move on to relative strength. So relative strength, this is actually one of the aggressive groups that's looking pretty good to me, the industrials. So when you look at this, this is a 5-year relative strength chart showing industrials relative to the S&P 500. So really over the past 4 or 5 years, we've been going down. Here was the big drop with the pandemic, the big rally coming out of the pandemic. And then finally, about a year ago, we saw industrials on a relative basis start rolling back over again. Well, I mean, for now, at least in the short term, we're moving back up. I wouldn't be surprised maybe if we take one more move down But at least for now, we are seeing industrials performing pretty well. One industry group within the industrials that I think looks kind of interesting is waste and disposal services. So you can see we bottomed here probably about 16 months ago, February of 2021. And this is a group, an industry group that's actually been trending higher versus the S&P 500 for quite a while. When we got up to this relative high here in April, we were actually not far from clearing key relative highs from the last 2 or 3 years. Now, if you look at the last 5 or 6 weeks, this group's been pulling back relative to the S&P 500. So it could be presenting an opportunity as we get down closer and closer to this 20-week relative moving average. I think the better maybe some stocks within this group would look. And there was one stock, I went through a number of waste and disposal services stocks. One stock caught my attention, and I don't know that I'd want to buy it on a pullback. I'd actually be more interested in buying it if it broke out. And that's PCT, which is Pure Cycle Technologies. AD line, nothing to write home about. And you look at the price action, you're like, well, you know, what could be good here? Well, when I looked at the chart, I just saw this $10 area. You know, when we go back, I can go back another year, and you'll see that that's about where it opened. The IPO was right here at $10. And so when it started moving up the end of 2020 into the first quarter of 2021, it ran from 10 to 35 in a fairly short period of time. And then within 2 months was all the way back to 10. You know, a little over a month later, back to 28. 2 months later, back to 11. I mean, the volatility was crazy. But this downtrend continued, excuse me, until we ultimately broke below $10. Got all the way down to 5. And notice this rally stops at 10. And we come back down, and then we rally, we stop at 10. We come back down, hold the 20-day, and then rally back to 10. So we've been continually bumping up against this 10 level. Now, we know this is a volatile stock. So just keep in mind, if you are a trader, or you like to trade, this is a stock that presents a lot of risk. So we do want to be somewhat careful, make sure you have your stops in play. Maybe for many of you, if you're risk averse, you may want to just simply avoid the stock because it is, you can see it from the chart, very, very volatile. But it's also one that can make you a lot of money. So if you're okay with taking additional risk, it's one that could pan out really nicely. But I'd like to see the volume pick up and get back through this 10, 10 and a quarter area. And I think if we could do that, given that this group overall has been a pretty strong group for the last 16 months, and then you get a breakout on a stock that has volatile tendencies, but hasn't been above that 10, 10 and a quarter level in a while. I think if you get some volume coming in on that move, that rally could last for a bit. So that's a stock that I would be interested in at least taking a look at. And this is kind of a top-down approach. You know, we start looking at the sector level. We see that, you know, this year, industrials are starting to show a little relative strength. You find a industry group within that sector that's been showing some relative strength, even a little bit of a pullback. And then you find stocks within that industry group that look interesting. That's really the way I try to approach the market. It's more of a top-down approach. Now, if I go back and I look at some of these other sectors, you know, if we want to look at the relative strength in some of these other groups, I mean, here's technology. To me, it looks like we're still trending lower. We bottomed in April and we've rallied a little bit on a relative basis off that low, but the overall trend here still seems to be down. Relative price actions below the relative 20-day, which is below that relative 50-day. That still tells me we probably got more downside. We could potentially go all the way back down to this May 2021 relative low. You know, if we have another leg down and we see the S&P 500 break down, it's very possible technology moves down with it, leads it to the downside. We'll see. Consumer discretionary. This is the one that just kind of beats me over the head that we're either in the midst of a recession or we're on the verge of one. I think that we're in one. We've already had 1 quarter of negative GDP. I wouldn't be surprised if we have a second one, especially if the Fed keeps raising rates. We've got consumer sentiment that's been dropping or has dropped over the last 12 to 15 months. We got consumer stocks getting hit hard. Not only are consumer stocks going down, but it's consumer discretionary. It's going down faster than staples. That's Wall Street essentially telegraphing to us that, there's a potential recession here at hand. Now, the good news is a lot of times the stock market will bottom before we ever get the news that we're in a recession or that we had a recession. So the market tends to go down before you ever even start hearing about a recession. I talked about this 6 months ago, that once we get past the inflation scare, the next thing up was going to be recession. And here it is. And I think we've got, I think this chart certainly is one that would align with a possible or a potential recession, maybe even being in one right now. But I do think we will rally back. And this is a group that will lead later in the year. So I actually like building a position in the XLY, if you're an ETF trader. Again, that's just my opinion. You don't have to listen to me. If you think we're in a secular bear market, we're going to go down for the next 2 years and it's going to be like 2009 all over again, feel free. Everybody's entitled to their own opinion. I don't see it. I don't see it at all. I think most of the selling has been accomplished at this point. I do think we could have one more leg down. 3,500 was a number I pointed out 6 months ago, 5 months ago. And I do think that we could see 3,500 on the S&P 500. If that happens, maybe we go down one more time here on a relative basis, or maybe the S&P goes down, but this relative ratio goes up. So money would start rotating back into consumer discretionary. That would be a really bullish development for the market, by the way. Communication services has been horrible, gotten a little bit of a bounce. But if you've been in internet, broadcasting and entertainment, stocks like Disney, Netflix, all these kinds of stocks, Facebook, Snap. This is what's been going on. If you're wondering why those stocks are going down, the whole group's going down. Some of the stocks obviously are going down faster than others, but this is the big problem. And those are your 3 big areas, by the way: technology, discretionary, and communication services. These are the 3 that I want to see doing well. And they're just not yet doing well enough to call a bottom. I want to call a bottom, and we could have bottomed. Not every bottom is the same, but I believe that we've got one more down move in this. And it's likely to coincide with the summer. Could be late June, could be September. I think it's going to be in that period that we bottom. And I think we are going to have a rip-roaring rally into the end of this year. We'll see. We shall see. All right, so that's it. Excuse me, for relative strength. Let's talk a little bit about earnings. Not a whole lot here to talk about. Five Below came out after the bell. They beat on their bottom line. Market was expecting 58 cents. They posted 59 cents. You want to see what they got for their great results? An 8.25% drop after hours. So 124.20, which is going to take us back into this gap area. So recently we jumped from 115 to 140. Well, 140 is kind of old news now, because after hours, like I said, down 11 bucks, 124. Seems like probably we're going to head back down toward this 110, 112 area. I'll, give it one shot maybe to hold on to gap support, which is around 122. But if that doesn't hold, I see us going back down and testing those recent lows. So not a very good report there. The other one that I didn't think was very good, at least not a good reaction, was Skillsoft Corp. Little stock, only a $1 billion company. Closed at 634 on Wednesday, after hours 580, down 8.5%. They simply matched consensus estimates. So the market was expecting a 21-cent loss, and that's exactly what came in, 21-cent loss. Skillsoft had been in a downtrend. We did have a rally here over the last month or so. I think that probably set up the downside move. If we go back down and close below that 20-day EMA, looks like maybe we're going to open just above it. Let's pull it up on a regular chart so we can see that. 20-day is 569. So 580 is where we are right now. So it looks like we're going to potentially in the morning open just above the 20-day. We'll see where we open. That 20-day needs to hold, in my opinion, on a closing basis. So we'll see whether or not that happens tomorrow. All right, last thing, the 3 you must see. I'm going to start off. I tell you, I'm just going to go through the 3 worst Dow performers. I'm going to start it off with Intel. Intel, after having a pretty nice rally from 40 and change up to 45 at the end of May, right back down, and actually we set a new closing low. We didn't take out the intraday low, but we closed below these prior lows. So Intel sets a new low. And of course, if we pull this up on a relative basis, you will see that Intel relative to the semiconductors rolling over again. Semiconductors were down today and potentially poised to go back and challenge that 6,500 level. But Intel down versus its peers, rolling back over. And you can see relative to the S&P 500, a new 52-week low. So that did not bode well for the Dow Jones. Next up, Goldman Sachs. So Goldman Sachs still in this downtrend. I think probably could annotate here. So I might watch that. I don't know if there's a channel we can connect. Well, no, not really. But that's the low. So, I mean, if we were to go back down and fail to hold this as we go out further in time, I mean, you could see potentially a move all the way down to test this lower channel line. One thing I will add is that a lot of folks like to use trend lines. And so some might look at this and say that was, let's get rid of this other line. Some could look at this and say, oh, look, we got a breakout. Well, the problem I have with that is, number one, you're really only connecting 2 points, almost 3 if you count this one. But a trend line, I mean, here's a trend line right here. You break that and then you fall back down. You got to be careful just connecting 2 lines. So I would be using this maybe as a channel, and then we'll see whether or not recent price support holds. So that's Goldman Sachs. And the last one I have for you real quick, just JP Morgan on the banks. JP Morgan hasn't been a great performer of late. Here we go. Rolling back over. I just want to see those moving averages hold. If they don't, then we could have some more problems. Anyhow, that's it for me. I appreciate everybody tuning in. Have a great rest of your day and rest of your weekend. I'll be back at Earnings Beats on Monday for your next Trading Places Live. Take care. Happy trading, everybody.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.